Cool. Good morning, everybody. It's now 11 o'clock, and we should probably get going because obviously, being first of the session of the month is the lot to cover. So, as usual, I've got a bit of news to do, and then we'll be talking to Andrew McHattie, and then the plan is to talk to Peter Hewitt from CT Managed Portfolio. So, without further ado, there's a few bits of news this week. I just pulled out two. So, Pershing Square and the JPMorgan Japanese merger. Andrew's going to cover another one, which is a Crystal Amber thing. I was mentioned something else at the end. But Pershing Square first. This is massive. It's the second biggest fund in the sector. Maybe not as well known as it should be, given that, but there we go. It had a bit of a tumble last week, and we'll talk about that in a second. Morningstar are very good with the numbers on it, so we've got no NAV or discount chart on here, but the discount is about 25%. And it does have a small yield. The big story this week is that its planned US closed-end fund is not going to go ahead. So it was planning to IPO. When Bill Ackman was talking about it early on, he started banding around numbers like $25 billion, biggest IPO of all time or something. I don't know, closed-end fund IPO. Anyway, when it came down to it, they cut the target size, and they couldn't get to the 2 billion target that they wanted, and so they had to pull it, which is a bit of a come down, obviously. Now, the reason why this isn't interesting for shareholders, the Pershing Square holdings in London, is that the fees on the new US vehicle were supposed to offset the performance fees on the London one. So had it all gone ahead, we would have been much better off. The other thing that was supposed to happen, I think, was that he was going to buy a big chunk of Pershing Square Holdings' stake in Universal Music Group. Probably a bit too late in the day, as we'll talk about in a second, but that's definitely an issue. And then the third thing, within the whole Pershing Square group of things, they've got this structure, Pershing Square Tontine Holdings, which is supposed to be an ideal vehicle for people to reverse the IPO into. So you've got your honesty company, you basically stock swap for shares in this. And that was designed to work by having support from the new vehicle, the existing London vehicle, and other funds managed by Pershing Square, as well as other interested investors. So now the sorts of deals that it can do are very much smaller, if it does anything at all. So it's really very bad news for his business, I suppose. Now, one of the reasons that people might have changed their minds at the last minute might have been the disaster that was UMG. It didn't look particularly good. It's not a huge fall. You can see there was the trading update on the 25th of July, basically around a slowdown in subscription revenue. So it's obviously selling music through people like Spotify and other streamers, and Amazon and Apple are supposed to have slowed down. And also they lost a bunch of revenue from Meta because they were streaming video content onto Meta, and Meta said we don't want it anymore. So it still grew, but nowhere near as fast as it should have done. And even after that fall, it's still on a fairly chunky rating, about some 26 times or something. So it's a bit expensive. It's way too big a position in the fund. It's about a 25% position, but we don't know that for sure because they're quite cagey about telling us exactly how big the position sizes are. But nevertheless, it was way too big, and that was why I think we were keen to see it being sold down. And that not happening is obviously a problem. But maybe this will bounce and maybe it will be okay. We just have to wait and see. Now, JPMorgan Japanese. This is a fund that we write on, so you should hopefully know it relatively well. And it had a real tumble when interest rates started to rise in the West. There didn't seem to be an awful lot of logic behind that, as far as I can work out, because interest rates obviously were not going up in Japan. And so therefore valuations of growth stocks in Japan, I think, should not have been as badly hit as they were, but they were nevertheless they were. And this is very much a growth stock portfolio. It's also although it's in the large cap sector, not a pure large cap fund. It's got some small and mid caps in the portfolio too. It's a decent size, one of the biggest Japanese funds there is. And the discount's been coming in recently. And partly that's because the share price has been ticking up, but also the NAV's come off just in the last couple of days because the yen has started to move, and that's sort of people are readjusting their portfolios on the back of that. So there's been quite a lot of selling by US investors. So there we go. So that's been recovering. I mean, it's a slow and steady process, but it has been recovering. And actually, when you look at that shift from here to here, it is fairly dramatic. But the small cap version of the fund has not been recovering, and it was already too small. The discount's steadily too wide. It's buying back stock, trying to do something about it, and shrinking. It does have a yield, but it's a manufactured yield because it's one of the sort of classic JPMorgan structures where they convert some capital into income to pay a 4% yield on NAV. But that wasn't enough to get people interested in the fund. And so it's been sort of slowly dwindling. The results that they put out on the 21st of June were not very good, and the board acknowledged that and said the result was disappointing. And at the same time, the main portfolio manager stepped down. So there was a bit of sort of succession crisis going on there. They needed to say about that. But the main problem, I think, because the board, there was no indication in those results that the board was thinking they needed to do something, but the shareholder base has got quite a lot of discount players on it. So City of London, Lazard, Allspring, 1607 make up a fair chunk of the portfolio. And they may have been agitating for something to happen in the background. You don't know. So the structure of the deal is exactly the same as we've seen with all the other ones we've seen. So Section 110 merger, JFJ absorbs SGI, which effectively is liquidated. There's a 25% cash exit, which is quite chunky, and that's a 2% discount to forming asset value. So it's the NAV after the costs have been taken out. The default option is shares in JFJ. So that's what you get if you don't tick any boxes or don't interact with it. The costs of doing the deal are all being covered by JPMorgan, but it's not a cash injection. They're basically going to say we're not going to charge a fee until JFJ's expenses have been covered. It doesn't cover the expenses of those exiting via the cash option. So that means that formula asset value will be knocked down a fair chunk, I would have thought, but we don't know how much until we see the paperwork. There's a quid pro quo too in terms of like a fee cut. So it's a tiered structure, much lower rates and much more sensible numbers than the last lot. And I reckon that saves about just shy of £700,000 a year based on the maximum amount of money going out the door. The ongoing managers stay the same. So you've probably seen Nicholas and Miyako present on here before. You obviously read our notes too. They are thinking about should they review the dividend policy. They're going to talk to shareholders first. Me instinctively doesn't like the idea because this is very much a growth portfolio, and so all of the income will be manufactured more or less. So it's sort of steady flow of money out the door. But we'll see if people want it, then people want it. We're going to get the documents in September, meetings in October. Everything should be wrapped up by the end of October. I think this is a done deal. I can't really see anybody coming in and spoiling the party, but you never know. Now, let's hand over to Andrew.
Great, thank you, James. I'll just switch over to my screen and then I'll talk about this month's movers. And it was quite a decent month overall for investment companies. The sector was up about 2%. That's before today, so that was over the calendar month. And there were a decent smattering of double-digit gains, as you can see from the list. A couple of really interesting ones, actually, near the top that I'll talk about. And generally, there were some trends here. Some very obvious trends, in fact. So the two in purple, I think, were quite special cases that I'll talk about. But also amongst the risers here, there were a lot of smaller company trusts, in particular UK smaller company trusts, which have been rather out of the limelight for quite some time. And I'll talk about the rotation that's occurred in the market and has pushed up these trusts actually quite nicely in many cases. The flip side of that is that on the downside, we have seen some falls in the technology trusts that were previously leading the way. So Manchester and London, Allianz Technology and Polar Capital Technology all had a bit of a slide this month. I don't think that's, and it was interesting. I talked about these last month, didn't I? And actually, just what a difficult decision it was as to whether you should be putting any more money in at these extended valuations. So we have our short-term answer anyway here for the moment, but I don't think there's anything too fundamental to worry about. So if you're a long-term holder, I would stick with these. It's quite interesting that we've got the two Chinese trusts on the list of fallers here. My feeling is that that's really because of the preeminence of Donald Trump in the US and his probably favorite spot in the leadership now for the US presidency. There are quite a few worries that he will be restricting global trade, that he'll retreat to a more protectionist stance, and that will be bad news for trade with China and general relations. So I think that's why that's happened. But let's talk about Crystal Amber, which was one of the biggest risers over the month. The shares went up 20% yesterday. I have talked about this trust before, and it's a bit of a curiosity, really. It's a relatively small trust. It's in wind down mode, although that's a pretty extended wind down period. And it's a very concentrated portfolio. It's a really frustrating trust to be researching, actually, because it has a really terrible website and it doesn't produce monthly fact sheets, and it's really generally quite difficult to find out exactly what the positions are. But we do know that it has basically two very big holdings. One is Morphic Medical, which is an unlisted holding, nearly 50% of assets at the end of June. This is a very interesting medical devices company in its early stages. And its main product is actually a medical implant, which is really an alternative to these anti-obesity, anti-diabetes drugs, such as Ozempic, which you will have undoubtedly read about. This is actually an implant that mimics gastric bypass surgery, but it's quite easy to put in and to remove again. So it's a decent alternative. And this company is in its pre-sales period. So it's just trying to get all of the relevant regulatory clearances it needs to start marketing the drug, the implant, and to start selling it. I think on that basis, the value of the company is a bit uncertain. And that's why Crystal Amber actually commissioned an independent third-party valuation of the holding, which is obviously very important for this trust. And that's just come back and reported an end July valuation for Morphic of just under 100 million US dollars. And Crystal Amber accounts for most of that. And this takes into account such things as the vesting of management options and so on. And what this valuation does, it potentially boosts the NAV here really very significantly. From the last stated value for Crystal Amber was 117.85 at the end of June. If you take into account this new valuation of Morphic, that leaps right up to 172.67. So that's clearly a very substantial increase. Now, I do have a little bit of skepticism about this because, this was a report commissioned by Crystal Amber after all. So I think it's reasonable, actually, that the rise in the shares wouldn't have taken account of the whole of this increase. And actually, you see that in the market now, that the shares are still on a 37.7% discount to that higher valuation. But it's nevertheless an interesting situation. And I feel after a quite long period where it was having a tough time of it, the wind is perhaps turning very much in the favor of Crystal Amber now, because its other big holding as well, De La Rue, the banknote printer, is currently in the throes of a possible takeover situation. And its shares are also standing close to an all-time high. So, it's a very interesting trust, I think, Crystal Amber. Undoubtedly very risky, though, because of that concentration. And that led me to have a look at other highly concentrated trusts, actually, which I think is really interesting because we have seen some big rises of late, not just from Crystal Amber, but also from the other one at the top there, Castle Group, which did very well from a debt reduction activity and its big holding in the Dignity funeral business. And we've also seen, of course, 3i doing tremendously well over recent years from its very, very concentrated holding in Action. But of course, for most of us, this is not really what investment trusts are meant to do. They're meant to be highly diversified trusts that, spread your risk. And so I think it's very much a two-sided coin, this, that you can do extremely well from some of these trusts when these big holdings are performing well, but there's a lot of risk involved. And so they're not for everybody. And I think the key thing is just to be aware of trusts that are highly concentrated, which is why I produced this little list here. I just created this yesterday by having a think about some of the trusts I knew that were concentrated. So there may be some glaring omissions. Forgive me if that's true, but it is interesting to think about these trusts. And some of these, of course, are well known, like Manchester and London, which has been absolutely soaring over the last 12 months because of its big holdings in Nvidia and Microsoft. And we've seen some quite interesting changes here. So the one at the bottom of the list, Schroders Capital Global Innovation, that's the old Woodford Patient Capital Trust. I put that on there not because the holdings in Atom Bank and Oxford Nanopore are so huge now, but because they were, in fact, a lot bigger. So Oxford Nanopore was a much, much bigger holding. And that's been a case of where this concentration has cost the trust. So I think it's important to bear these kind of concentrations in mind. But they're certainly very interesting and you can sometimes benefit. I think Hanster is an interesting case because Ocean Wilson's is pondering what it's going to be doing next, and there could be a potential uplift there, but it does certainly increase the risk. Of course, on the list here, I have not included alternative asset trusts where some of their projects concentration is also very high. We've seen that, of course, in cases like Digital 9 infrastructure. So those are also potentially risky. But let's talk about the market rotation that's occurred. And there's been a definite sell-off in the Magnificent Seven in the US. I think some slightly disappointing results from Alphabet and Tesla triggered this, but it seems like it was a bit of an excuse, really, just to take some profits, take a little bit of money off the table after what has been a really fantastic run. I think as well that because economic conditions seem to be improving, or there's the potential for that to happen with some lower interest rates, this has meant that actually, if you're looking for growth, you don't have to be quite as concentrated any longer, and you can broaden out your search towards companies and trusts that are not so highly valued. And I think that means that UK smaller companies trusts have been particularly obvious as a place to look because we know that UK smaller companies are out of favour. There's been lots of M&A as evidence of that occurring. We know that the UK more broadly has been a bit of a pariah state as far as international investors are concerned now for a number of years. And of course, on top of that, you have the broader discounts in the investment trust sector as well, although they are starting to come in now. So you have this potential triple whammy of opportunity here for investors that are looking for more keenly valued stocks, let's say. And we have seen actually smaller companies in the UK starting to outperform large ones after a period where that wasn't the case. This chart here just plots the FTSE small cap index in the black against the FTSE 100 index in the blue. And you can see actually they traded in tandem for most of the last year, but in May, actually, we saw a bit of separation and we've seen UK small caps starting to outperform, which again, I think has been a bit of a trigger for some money to flow back into the sector. So we'll have to see if that will continue. I dare say Peter will be addressing that question. I hope he will. And there are, of course, plenty of opportunities in the UK smaller companies trust sector. It's a very big sector. You need good eyesight to look at this, but I've ranked the UK small cap trusts here in discount order. So broadest discounts at the top. You can go and look at this yourself and get some up-to-date figures, but I think the point I would make here is that there is a very broad dispersion in this sector. And so, for example, towards the top there, I did highlight actually a couple of months ago in my newsletter the anomalous situation of Oryx International Growth, which in spite of its name is a UK small cap trust. And that's trading on a much, much wider discount than its Harwood stablemates, Odyssean and Rockwood, which are both on premium ratings. So I think you have to pick carefully. But to my mind too, whilst the valuation is important here, clearly in the UK small cap space, stock picking is of paramount importance, and the quality of the manager is really, I think, the absolutely key thing. So you have to be quite careful, I think, about how you're picking. The final slide from me is just really relating to yesterday's news. Yesterday's news that interest rates were cut modestly by the Bank of England. This was a slight surprise. It was a 5-4 vote on the Monetary Committee, so very close. And the market actually reacted well initially and then decided that because actually the Federal Reserve was not cutting its interest rates, it wasn't that impressed after all. My sense is, though, that this is very good news in the medium term for the investment trust sector. It's not only supportive for UK smaller companies, but there are a number of very important sectors actually that ought to benefit from this. These are generally the ones that we've seen being quite depressed over the last couple of years. So real estate is an obvious beneficiary of lower interest rates because debt is always a big part of the asset mix there. Infrastructure and renewable energy, because these trusts are competing perhaps to some extent with returns from UK fixed interest, that's relevant. And also because, of course, they value their assets using discount rates. And if the discount rates come down, the value of the assets goes up. So I think actually this could prove very important for those trusts which are generally on very wide discounts at the current time. The third sector there, the final one, is growth capital, where again, if you're an investor looking out at future returns from growth capital, which could be some years hence, and you're discounting those back to present values, if you're using a discount rate that is lower now the interest rates are coming down, that increases those present values. So again, that may encourage investors to take a fresh look at some of the growth capital trusts that are still on very wide discounts. So overall, in spite of the market's near-term reaction being somewhat less than excited, I think it is very, very good news for the investment trust sector that interest rates appear to be coming down at last. So in the absence of any questions, I think that's it from me, James. So I'll hand you back for a chat with Peter.
Great. Thank you very much, Andrew. Always interesting.